Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500 and today is Constellation Brands, ticker STZ. Over the next few minutes, I'll discuss my thoughts on both the valuation of this company and its business quality. This company has a market cap of $48 billion, enterprise value of $58 billion, which means they have about $10 billion in net leverage on this business. However, they're operating in the beverages industry, so that tends to be a relatively good industry. Constellation Brands produces, imports, markets, and sells beer, wine, and spirits in the United States, Canada, Mexico, New Zealand, and Italy. So these are very good areas of business to operate in. The beverage industry is quite good, and the alcoholic industry tends to be quite high quality as well. We'll see if that plays out in the numbers, especially when you think about the powered brands. And you see some of their brands here: Corona Extra, Corona Premier, Corona Light, Modelo, Victoria, Pacifico, Wine Under 7 Moons, Cook's California, Cooper Thief, Crafters Union. They also have Spirits, Casa Nobel, Copper Kings, High West, Mi Campo, Nelson's, Greenbrier, Svedka brands. So you can see very good section of the business market to be very good industry, so that tends to mean it's going to be relatively high quality. Now, what do we see here? I do see it looks like 4 years of losses in the last 20 years. That's quite high. It's very high for my taste. So I'd like it to be 1 or 0. So that would mean 19 or 20 years of profitability. But here we see that they only have 16 years of profitability over the last 20 years. Now, I do wonder if some of these have some one-time adjustment numbers. We will have to investigate that, because when I look, for instance, 2020, they lost money, but it's not clear why, because you have gross profit higher than it was in 2019. You have revenue higher than it was in 2019. You have operating profit higher than it was in 2019. You had operating margins higher than it was in 2019, but the EPS went negative. So what's going on there? Is this a one-time adjustment? It looks like it, because you bounced back pretty well in 2021. In addition, the same thing's true in 2022. Are these negative numbers real? And that's one thing we're going to investigate as we go further into this video, because if those numbers aren't real, even if just these two numbers aren't real, and then we can say maybe this is 2008, 2009, the recession, one of the worst recessions in recent history. So otherwise, they've been making profits. That's a big positive sign for their operations, especially when you think about like the improvement in operations here. You started getting up to 15% return on invested capital in 2019. Those are very, very strong numbers. So it's mixed on this initial analysis in terms of quality, but because I like to see 10% return on invested capital, but they're at my target of 15% plus return on equity. 16% is quite good. Very good numbers. I like that I see there. Now, valuation becomes a problem. PE of 38 is very, very high. Now, what I have to wonder is, what is this PE on? So 38, it might be based on this 2021 number of $10. So I'm going to have to figure that out, because PE of 38 is just too high to pay for any company. You're not growing at 30, 40, 50% a year. You're growing at 12 to 13%. Those are good growth rates, but not amazing growth rates. You should be able to buy a company with this sort of growth rate at a PE of 15 to 20, 25, maybe. But I'd ideally like to buy it in that 15 range with something like this revenue growth rate. So 15 to 20 is really the target I'd like to be. That means you're about 2 times too high of price based on this PE number. However, again, these numbers look like they have some one-time adjustments. Maybe that's also building into the price to earnings ratio. We'll have to discover that further over time. Now, let's look at this. So growing revenue at 12%, anytime you're growing at double-digit rates, that's very, very good, especially when you're paying dividends. You can see they've been paying dividends for the last 7 years. 7 years of dividends. The dividends have been growing. Very good sign there. And so you're able to grow quite quickly, even at the top line, even though you're paying dividends. Now, that growth has slowed over the last 5 years. If we just look from 2018 to 2021, your revenue growth rate 3, 7, 2, 3, 2. Maybe your actual growth rate now is no longer double digits. You have a big adjustment here from 2014, 74% growth. Big adjustment here in 2015, 23% growth. There could have been acquisitions that drove that. And so maybe without acquisitions, your organic revenue growth is in the 5% range. So that makes it a lot less attractive. It's also important because that would make this PE ratio even worse to think about if you can't rely on double-digit revenue growth rates. Now, You do see the operating margin growing over time. That's very attractive to have that operating leverage. It means that a lot of this money is falling to the bottom line. That's partly because, again, your gross margin's also grown. Very attractive operating leverage in this business. It makes it very strong for future growth. So it's hard to tell what your long-term earnings per share growth rate could be, but you can see how strong this could be. I mean, look, they tripled revenue, less than tripled revenue from 2013 to 2016, but the earnings per share went up ninefold from $2 a share to $17.50. So it just shows the power of the operating leverage inherent in this business model. Very strong business model from what I'm saying here. Could be a very high quality company going forward, depending upon how these numbers actually roll out. If you're enjoying this video so far, hit that like button. I really need your likes to help tell YouTube that you're enjoying this content, to recommend it to others. That's what helps drive people to recommend it to others, and that you're subscribed. If you don't subscribe, YouTube doesn't think that you like the content as much. They're not going to recommend it to you as much. But if you want to make sure to get all my future videos, if you like how I cover companies, you need to be subscribed. Ring the bell so you can get notified as I upload new videos. Right now, it's Monday, Wednesday, Friday every week, 3 videos each week covering different stocks, different ideas. And so you should stay tuned for that. Now, let's go to the income statement. One thing we can see on the income statement is you do have cost of goods sold rising pretty quickly with revenue. You've tripled your SG&A, but you've more than 4x'd your gross profit, so that's good. It's showing some of the operating leverage. Everything there is good. You do see that they're paying, of course, that debt to get the extra leverage on the business. No qualms with that. That seems to make a lot of sense. Now, it's interesting. It looks like they've diluted, because the shares outstanding has gone from 182 to 191. However, that doesn't tell the full story, because you've actually gone from 190 shares diluted outstanding to 191. So they've clearly been buying back shares from 2017 on, and they've been reinvesting that money in the business, and you've now matched out the shares outstanding basic versus diluted, which is a good sign for that they're not diluting you as much going forward. But maybe we can see more with that on the cash flow statement. So we'll skip ahead to the cash flow statement. You do see the stock-based compensation. They are still diluting the stock-based compensation, but you do get some buybacks here that's offsetting it. And the buybacks, when they do occur, 500 million, 1 billion, significantly exceed the 50 billion range of stock-based compensation. I don't really know why you need stock-based compensation in a beverage company. I don't like stock-based compensation, but it is what you can see there. Now let's go to the income statement, see if we can figure out 2020 and 2022. And here it is. Other non-operating income. You can see the operating profit's doing quite well. 10 straight years of operating profit, growing steadily, up 6x over the decade. Very, very strong business. But you have one-time impacts in 2020 and 2022 that are destroying what looks like your income here. In addition, the PE is not as bad as it looks, because you have, again, another $1 billion in, maybe is this write-offs over the trailing 12 months. So, if you adjust that up and say, okay, maybe if we take that out, I'm at $2.7 billion. And if we go to the market cap, $2.7 billion. So now you're at a PE of under 20. Gets a lot more attractive. A lot more attractive to see that. So the price is not nearly as bad as I thought, because let's see if we can get a comparable pre-tax income here. It's going to be something like this $10, something like this. Maybe not. It's going to be somewhere in that range, in between $10 and $18. So 2020 and 22 were neither real losses. They do have, if these write-offs, that can be real. You can see that 2019 is also not a real number. But your earnings are probably in that $10 to $15 range per share, which makes this a lot more attractive again, because now you're no longer talking about 38 PE. You're talking about the 15 to 20 range that I was really targeting. That can be very, very attractive. You like to see that. So when you can have this growth, then now the PE looks attractive and interesting because it's in the right target range. However, again, is the revenue growth sustainable? I don't know. That would be part of what your investigation is. Does this revenue growth come from acquisitions? And we can see some of that here. They do have acquisitions. There was a big acquisition in 2014, big acquisition in 2016. You had some acquisitions, it looks like almost every year for a while now. That's leading to some of this big growth that we saw in the revenue statement. And so you're getting that dry cash flow. Net issuance of debt. You can see the debt growing, they're paying dividends, it's starting to grow. It's not a big impact on their business, but it's nice that they're still growing. So this company looks really attractive. I would say it would go on my watch list, because what I'm seeing here is they're seeing improving returns, but there's a difference here. I would really like to see faster growth. So I am curious. It would require some extra work before I actually bought, but the operating leverage here is key. You're operating in a very good business. These strong gross profit margins, growing operating profit margins, everything here looks really good. Obviously, it would require some additional research, but it looks like a very attractive business, so I'm definitely interested in what I see and would be interested in doing further work on this company. So Constellation Brands, going on my watch list, very interesting company, good industry, could be of an attractive price, but again, there's a lot of one-time adjustments I would need to take into account to really understand what's going on there. If you enjoyed this video, please hit the like button. Don't forget to subscribe. You need to be subscribed so you can get access to all my new videos that I'm coming out with. If you enjoy this content, you also have a backlog of over 100 videos covering S&P 500 companies. Check out that playlist where I cover it. It should be showing up shortly, where you can look at all of the past S&P 500 review videos. So if you enjoy using this software that I see, this is the software I use to do my first looks for companies. This is real. This is what I'm doing as I do my own research. So if you like the software, check out quickfs.net. My referral link is in the description below. It's the first link there. If you click my referral link, I would really appreciate it. It's no cost to you, but if you sign up, then I can get a commission for forwarding you to the software that I use. I don't recommend anything that I don't use myself, and I love using quickfs.net. So again, check it out if you find it interesting. You can sign up for free or paid accounts to give you different features as well. Thank you for listening, and until next time, stop paying fees, start building wealth.